Hi, this is Richard Vague with Tychos, and today we're going to talk about oil prices. As of November 17th, West Texas Intermediate crude oil had declined moderately in price to $76 a barrel, defying expectations of higher prices due to concerns about war, and bringing the hope of continued relief from high gas prices to U.S. households. Now $3.41 a gallon as of November 20th, 2023, down from $3.66 a gallon a month ago and $5.10 a gallon in June of 2022. But it was likely not welcome news in Saudi Arabia or Russia, who are so heavily dependent on oil revenue. But let's dig a little deeper. It's fascinating to look at the history of oil consumption in the U.S. It took off on a steady upward trend starting around the time of the Civil War with the discovery of oil in northwest Pennsylvania, coupled with the discovery of an efficient way to extract it. Oil was plentiful and cheap, it fueled the automobile age, and its use continued to climb decade after decade until it reached an incredible peak of 4,242 kilograms of oil equivalent in the 1970s, an era in which the cars were massive and clumsy and often got less than 13 miles to the gallon as compared to 18 gallons or more today. With the inflation of the 1960s, a mild bout in retrospect, the U.S. government took the controversial step of instituting price controls, including a cap on the price at which domestically produced oil could be sold. So of course, and inevitably, the production of domestic oil fell. There wasn't an incentive all of a sudden, and we began to import far too much oil. Then came the storm. A cartel dominated by Saudi Arabia and other Middle Eastern countries, called the Organization of Petroleum Exporting Countries, or OPEC, had come to control 51% of all global oil production and thus could set the market price. With that power, when in the 1973 Yom Kippur War, the U.S. lent its support to Israel, OPEC acted to retaliate against the U.S. by raising prices, which quickly went from under $4 a barrel to $10 per barrel, which is $64 in today's or 2022's dollars, which drove up inflation disastrously for U.S. households. It got worse, since shortly after, in Iran, conservative Islamic forces took over the country from a U.S.-backed dictator, Mohammad Reza Pahlavi, the Shah of Iran, disrupting oil production and pushing the price all the way to $40 a barrel, or $144 in 2022 dollars. With that Iranian revolution, U.S. inflation reached a punishing 14%. Presidents Carter and Reagan sensibly deregulated the price of domestic oil, which then shot up, causing U.S. drilling activity to skyrocket. But that scramble pushed the price of oil all the way back down to $14 a barrel. It was supply and demand at work. At the very same time, the U.S. government and automakers acted to bring about improved gas mileage and the efficiency of our other oil use, which, as you can see on a per capita basis, has now declined by 25% from the 1970s peak. With that, we are simply not as vulnerable to an oil price shock as we were back then. But U.S. households are still vulnerable, much to our collective discredit. Fully 50 years after OPEC caused us so much pain, our economy is still far too dependent on oil, leaving us much more vulnerable than we should be to the preferences of major oil-producing countries like Saudi Arabia and Russia. Evidence of this vulnerability was all too clear in the bleak months following the Russian invasion of Ukraine, which pushed the price of oil to $109 a barrel, lifting inflation to 9%. Happily, inflation is now down to almost 3%, but war and/or the undesirable behavior of one or two erstwhile dictators could push oil prices up again and bring renewed inflationary pain. To get out of that trap, we need to reduce our dependence on oil. Even if we had no concerns about climate change or the environment, it makes little sense to have so much dependence on a single source of energy. We should invest resolutely in alternative sources of energy simply to increase our geopolitical strength and decrease our geopolitical risk. That's it for this week. Thanks.